In September, the pound plunged to its lowest level on record, reaching a low of 1.03 against the dollar during a day's trading. The markets were spooked by the government's unfunded tax cuts and likely $190 billion budget deficit. Investors viewed the Kwarteng Trust budget as a complete fiasco. They sold sterling, sold UK bonds, creating a mini crisis. Now, fortunately, intervention from the Bank of England, U-turns from the government, and then a new Prime Minister with a new strategy have helped to calm sterling. But is the crisis over? Is sterling now undervalued, or will its long, steady decline of recent decades continue? Recently, the Bank of England increased interest rates by 0.75%, which should in theory strengthen the pound. However, the bank also hinted that because of the depth of the recession, interest rates may rise less than market expectations. The bank feel that interest rates could now peak lower than, say, the US and the Eurozone, and this is because the bank is worried about recession in the UK for very good reason. The bank point out the UK economy is been hit by a combination of factors. Very high inflation of over 10%, causing a cost of living crisis and falling real wages. On top of this, we have rising mortgage costs. Households accustomed to ultra-low interest rates are now finding their disposable income will be squeezed, and it will be increasingly squeezed next year. Then, on top of that, we have the fiscal austerity of the government to fill their fiscal black hole, which will involve higher taxes, lower spending, lower public wages. And all this has, as you might expect, caused a collapse in consumer confidence. Therefore, the bank don't want to add to the depth of a recession, and this means that interest rates might rise less than previously expected. What the bank are hinting at is that they would prefer to see a fall in the value of the pound than create a deeper recession. By contrast, the Fed are more hawkish, arguing underlying inflation in the US is still a problem because the UK economy has had more stimulus and is growing quicker than, say, the UK or European economy. And this all points to the dollar remaining strong over the pound and continuing to appreciate in 2023. If we look at the value of a pound since 1913, we can see the general downward trend. In fact, the average is a fairly consistent 1% average decline per year. But it's not just against the dollar the pound has been weak. This graph shows the dismal performance of sterling against a basket of currencies in the past 15 years. The sterling exchange rate index shows sterling against currencies like the yen, euro and dollar, trade weighted. The 30% fall in sterling in 2009 was due to the UK economy's reliance on financial services, which were hit by the credit crunch. The 2016 vote was also important for sterling because it reduced expectations of the UK economy because of all the costs associated with leaving the single market and customs union. And this is reflected in recent poor export volumes and a decline in foreign investment. The ongoing issues around Brexit will weaken sterling in the long term because it makes the UK somewhat less attractive for capital flows and is damaging some export volumes. Another weakness for sterling is the size of the current account deficit. It doesn't get so much headlines these days, but is still important. The current account deficit reached a record 8% of GDP earlier in the year, before recovering to a deficit of around 5%. However, this winter, high gas and oil prices will cause a surge in the value of energy imports, causing an even bigger deficit and downward pressure on sterling. So, for example, the price of gas futures suggests the value of gas imports could rise from under 2 billion in July to over 8 billion a month by the end of the year. When you have a large current account deficit like the UK, this means we're importing more goods and services than we're exporting. So we need financing from capital inflows, e.g. foreign investment, people saving in UK banks, buying UK bonds. But these capital flows are becoming less certain because of a global slowdown, uncertainties around Brexit, and the poor long-term performance of the UK economy. And if these capital flows do dry up, it will all put downward pressure on sterling. A more optimistic note for sterling can be viewed when looking at long-term purchasing power parity. This looks at the value of an exchange rate compared to its purchasing power in a local economy. The simplest way to explain this is The Economist's Big Mac Index. So in July 2022, a Big Mac with pretty much the same ingredients cost £3.69 in the UK and $5.15 in the US. So on this relative price change, a fair exchange rate would be 1.4, but the actual exchange rate in July was 1.2, suggesting that on purchasing power parity, the pound was 14% undervalued and the dollar overvalued. Now, it should be said that the dollar is overvalued against nearly all currencies at the moment because of the strength of the dollar in 2022 and last year. By the way, back in the early 2000s, I remember when it was cheaper to buy a Mac computer in the US, because in those days the exchange rate was closer to $2 to £1, but the actual price of a new Mac was around £1,000 or $1,000. So you could save a lot by buying in the US, where the exchange rate gave you a really good deal. So with an exchange rate like that, the pound was always likely to fall because it makes sense for UK consumers to import US goods and therefore buy dollars. Now, in theory, it is more likely to be the other way around, but UK goods should be cheaper for US consumers. However, exchange rates can deviate from purchasing power parity for a long time. In the medium term, interest rates, expectations of growth, and the relative strength of economies and forecasts for future inflation. Investors may look at the UK productivity growth. Since it has been underperforming, the UK is more likely to see inflationary pressure in the long term than, say, the US. And it is these relative difference in inflation rates that affect currencies in the long term. Around 80% of a long decline in value of sterling against a dollar is due to the relative difference in inflation, which is due to the fact that basically the US has had better productivity growth than the UK. Another reason for the strength of the dollar versus the pound and euro is that European economies are much more vulnerable to high gas prices. Now, although prices have fallen a little in recent months, the crisis could easily get a lot worse. There is a real risk of escalation. Russia could cut off more gas, it could attack pipelines, and if it did this, it would be devastating for Europe and the UK, causing more inflation, recession, and a fall in the European currencies. The US is more protected because of this. Now, the big question is, will sterling buck the trend of the past 100 years? Will it buck the trend of the past 50 or 10 years? Well, it would still be a brave investor who bought sterling despite the apparent undervaluation on purchasing power parity. The Bank of England forecasts the longest recession for a generation. In this climate, the bank wants to keep interest rates as low as possible, whilst also trying to bring inflation down. And this short-term recession also can be added to the long-term underperformance of the UK economy, which all point towards a weaker sterling. And some of the longer-term issues around the UK include the poor productivity, low investment, low research and development relative to competitors, relatively poor skills in the workforce, creating a labour-intensive economy that has poor productivity, and then also all the costs and uncertainty of Brexit weighing down on the UK economy and therefore sterling. Hope you found the video useful. Please give it a thumbs up, subscribe to Economics Help, and see you soon.